Hi, I'm Llanes with Wealthnet Investments, and this is the Market Call of the Week. And I'm going to do something a little bit different this market call. I'm going to focus in, first of all, on what I call mastering the three balancing acts of a trader. We've done a lot of research on what are some of the important things that we need to do to manage a trade. And I want to go over some statistics and some examples for those of you who are investing on your own, or for those of you who work with a manager and want to kind of understand some of the balancing acts that managers have to deal with. It's very interesting stuff, and in fact, it's what I would consider part of the secret sauce of investing and making investment management more profitable. So let's go ahead and dive right in. So first, what I'm going to do is I'm going to go over some chart examples, and then I'm going to go over some statistics. Okay, let's go ahead and dive into mastering the three balancing acts of the trader. Okay, what are the three balancing acts? The first one is protecting your initial capital. One of the things that happens every time you invest money, you want to avoid large losses, because the way the math works is that if you have a single large loss, it can offset the profits of a lot of winners. So we want to avoid large losses, but at the same time, we want to give each investment enough room so that we can hold on to the winners. So let me dive in and go over an example of that. The first example I want to go over is Amazon. This is a chart of Amazon. And as you can see, Amazon has been one of the easiest stocks to identify as a big winner. But it's not always that easy to trade a company like Amazon, even the very best winners in the markets. And let me explain. Let's just look at some of the market action of Amazon over time. Depending on when you actually enter in a stock, when you first come in, if you have a drawdown in price that it moves against you right away, that you're going to have a dramatic loss in capital if you have too much money attached to that investment. So regardless of how well you've selected the stock, you still might go into a drawdown. So one of the arts is to make sure that you have the right position size so that you can withstand a normal drawdown. So that's part of the balancing act, is being able to hold on to the ones that are winners. And a little bit later on, I'm going to go over the statistics that actually show how much movement that a stock tends to have statistically so that you can hold on to those winners. The goal is to protect your initial capital, to balance that with the fact that you need to let as many of those winners in your portfolio to hold on to them. So that's the balancing act. Okay, suppose that you invested in Amazon and you decided that you were going to invest on 1/24/2014. At that time, the stock was trading at $408 a share. Well, it immediately went down all the way down to $284. Even though this was a great company, it had a drawdown in price. So the question is how much room do you give it, and how much of your capital do you risk? And we're going to talk a little bit more about that when I get to the statistics part. So I just want to use this as an example for the balancing act number one, which is giving ample room to your positions to hold the winners while protecting your profit, your capital. Okay, so now let's move on to the number two. The biggest balancing act, number two, is to avoid your winners turning into losers. So many times you can have a position on, and initially that position moves in your favor, and then it turns around and it turns into a loss over your time frame. It's really important to be able to take some profits, to bank some profits when it makes sense statistically, so that you can mitigate the negative effects of having a position that moves against you. So let's look at an example of how that could work. Here's ExxonMobil. ExxonMobil is a very choppy stock, and we don't own this stock or haven't owned it in a while. But let's just do a hypothetical. Let's say you had entered this stock right here where this green arrow is. Well, initially that stock popped very strongly in your favor. It looked very, very good, and it had a nice move. But then immediately you could see it just turn into a loser, and it happened very quickly. Those are kind of, some people call those a popcorn stock or a popcorn entry. Okay, so what do you do there? At some point, partial profits should be taken, because even the losers tend to have the ability to move in your favor a certain amount. We'll talk about that when we get to the statistics. So that's the balancing act number two, banking profits to help offset the negative effects of your winners turning into losers. So now let's talk about the balancing act number 3. That is to capitalize on your biggest winners. So you want to protect those open profits that you have not realized yet, while letting them run. So you want to bank those profits, but you also want to give them enough room to run. So that's the balancing act. And let's look at an example of that. So let's take a look at Visa. Visa is a prime example of one of our holdings that had many shakeouts where you could have gotten pulled out of the stock even though it was a big winner. Fundamentals are great on your side. The technicals were generally good, but there were times when it pulled back in price, and for those who were weak holders could have gotten taken completely out of the stock. So we want to be able to balance that ability to protect those profits as you earn them, but to also stay in them. And that has to do with your position size, giving them room. So if you just look at this chart, you can see how that happens. You have this general strong uptrend. I mean, you really couldn't ask for a better uptrend in the markets. This is one of the prime best uptrends we've seen, that on Amazon. I'm using those as examples just so you can see the idealized example. But you can see how these pullbacks could have literally pulled you out of the stock, and you could have lost out on many profits. You could see it was trading in the 50s all the way over over $140 a share. So really important to do that. So that's your balancing act number 3. That's to capitalize on your winners, avoid getting shaken out, letting those profits run. So now what I want to do is I want to dive into the statistics and talk about and explain a chart that we've developed that shows actual stock market statistics and how stocks tend to behave in history, what we've seen in history, and what that means in helping you analyze the probabilities and how you should handle your trades. So the number one thing when dealing with the management of your profits and your losses, you want to have a time frame in mind. Now in this chart, we have 2 time frames, a 63-day trading period, which is about one quarter, and then we have a 252-day trading period, which is about a year. So, and I'm going to focus in for our purposes right now just on the 1-year time frame, the 252 trading days, okay? So let's just look at number 1. So first of all, what this table does is it analyzes the daily volatility of the stocks. And then it actually takes that daily volatility and shows the most a stock would have gone up in a given time frame, in our case over a year, and the most it went down during that time frame. So, and then we break them down into winners and losers. So you have all observations, so that's all the stocks that we observed, and then we have just the winners. And what that means are those stocks that actually in that time frame ended up with a profit. You bought low and you sold high. And then we also have them broken down by losers. So in that time frame, they ultimately went down in price. Okay, we're going to look at statistics in terms of daily volatility. So each one of these numbers is what we call a multiple to APR, or average percent range. And let me explain what average percent range is. Average percent range is the true range, so it's the daily volatility, highs and lows throughout the day, divided by the close. So it's a percent. So it's how much in percent terms that we see on a daily basis. It's an average. And what we did is we said, okay, each one of these moves, we want to see how many multiples of that daily average percent range that we saw as of the date that we took the trade. So we knew what that number was going forward, right? We know what that is, right when we take the trade. We want to see in terms of daily average daily volatility, how much did we move up? So for example, if you have a number of 2, that means that it moved up 2 times the average daily percent range. Okay? So now, these are in terms of percentiles, and percentiles basically are measuring the percentage of the datas that were above or below a certain data point, a certain multiple. Okay, so that way we can tell what levels they are, and we can calculate probabilities. Okay, so now we've talked about that. Now I want to also explain what max up and max down means. The columns that say max up, that means the most that it went up during that time horizon in terms of APR. So for example, in the 252 time frame, at the 90th percentile, the stocks of the winners, because I'm in the winners column, of the winners, the most they went up 90% of them went up 40 times or less. So that means only 10% of the winners went up more than 40 times your daily volatility. I hope that makes some sense. So that's a really important number to know, right? So that's how you interpret these numbers. So we have the 252 day, and then we have the losers. Now I'm going to point right to the data points that make sense so that you can see what I'm talking about. So our first one we're going to talk about is that the number one balancing act is really where should we put our protective stops. So when we first get in, how do we let as many of those winners in as we possibly can, and at the same time protecting our capital, right? So if you look at it, if you look at number one, 75% of the winners allow you to hold, and you don't want them to move. They move at least 5.7 times your daily volatility. So 75% move 5.7 times your daily volatility. So you can see that right here. There's your number one. And actually, I accidentally have this on the 20. This should be right here on the 25. So 25% of them, right, went down by that. So that means the inverse of that is 75%. So what we're saying is that if you want to let 75% of those winners in your portfolio, you should give it at least 5.7 APRs, or average percent ranges, to go move against you. That's a really important number to know. If you want to capture 90% of those winners, then statistically the multiple is 9.7. Okay? So you want to give them ample room. And you can use this table to find your preference, but that is how you look at this table. So the other thing that we want to look at is the balancing act number two. Balancing act number two is protecting our gains, right? We're keeping those winners from turning into losers, those popcorn trades. Well, we can move on to the losers column, right here, the losers column, and say, okay, of those losers, how much do most of them tend to go up? So I can take a little bit off the table just in case this winner turns into a loser. And if you look at the statistics, about 50% go up 3.4 times. 3.4 times. So that means your winners that have gone up 3 times your daily risk half of them will turn into losers statistically based on this data. Now, the past doesn't always equal the future, but we've got a large data set, and that's something that we want to keep in mind. So this is what the probabilities have been based on our analysis. Okay, so maybe you take some of your money off. Maybe you take some of your money off when you've gone up 3.4 times if your time horizon is 1 year. Now, one thing to keep in mind is that this is all relative to your time frame. If you have a shorter time frame, it's a different number. If you have a longer time frame, it's a different number. All right, so now let's deal with the balancing act number 3, and that is capitalizing on those big winners. So what we want to do is we want to go to the winners column now over here, and we want to say, when we have a big win, how many multiples of APR does that really mean? Well, we can make that in terms of probability. So we can say here that 75% of your winners, most of them are not going to go up more than 26.6 times your daily volatility. So if you're going up more than 26.6, statistically in the past, only 25% have gone further than that. And if you're looking at 40 times, only 10% have gone more than that. So how you want to use that is that it helps you put things in perspective. If you've invested and your time frame is a year and you've gone up 30 times or 25 times, then you want to start looking for, okay, statistically, the odds are not as favorable for me that I'm going to, in my time frame, that I'm going to actually have a bigger winner than this. And you might want to start pulling some money off. And there's a bunch of rules. I'm not going to give you the specific rules because there's a lot of secret sauce involved with that. But I want to talk about the concept for those of you who trade on your own, or for those of you who just want to understand how we're dealing with managing positions and position sizing. We definitely want to understand how these work out. Now, obviously, we're looking at the valuations and how attractive they are fundamentally. Those are all really, really important things. But we also want to know just what we observe in the marketplace. It's very, very important because the markets are really a combination of what we observe and what we think is happening with the company. And there's, this is a whole nother segment to be discussing how we deal with that. But in this video, I wanted to talk a little bit about this concept of those three balancing acts. I hope you get some value out of that. Now, very quickly, I'm going to start diving in now to just a few highlights from the market in the past week, because this is our market call. So this chart here is our momentum chart, and our composite momentum is showing that the stock market is in fact still bullish. If you've been watching the market calls, you've seen that we went from a neutral 3 up to 5, and we're still sitting at that 5 level, which is our strongest momentum position. The breadth, which measures the number of securities that are moving in the right direction in a positive uptrend, that is still relatively positive. We see the McClellan oscillator here, which has pumped up to an overbought level, is pulling off of that. So this is normal when you have a breakout like we saw from these highs, and now we're moving higher. We also see the advanced decline line, which broke its trend, sideways trend in June, is still continuing to march forwards. That's all still positive. So when we look at the last 30 days and we look at the daily action, you can see we have a positive trend here. For the most part, it's just been easing its way up on low volatility. All right, so I want to talk a little bit about a couple of our holdings that have had earnings announcements. And we are moving into earnings season, and that's a big part of what we do, is listening to conference calls and see how our companies are doing. And two of note this week is IQVIA, which I mentioned in our last market call that I liked IQVIA. It actually popped up pretty nicely on an earnings report. As you can see here, we were trading, below the 110 area, and we've really shot up to 124 very quickly because they did a very good job on their earnings, and they've upped their anticipation for growth and for the fiscal year. So that was a positive event in one of our holdings. And GrubHub is another one that we recommended on Real Vision. This particular company actually popped up 18.33% as of now, up $20 a share. It has moved well beyond our valuation targets, so we're looking at this stock as being one to reduce. But yes, GrubHub, they did very well with their earnings reports. They continue to bring in more revenue from partnering with restaurants and really increasing the synergies and the marketability of the restaurants themselves. So it's a very symbiotic relationship between GrubHub and the restaurants, which is helping them increase their revenue as well. So that looks like a win-win there. However, we do think that stock is very, very high compared to its fundamentals now. So that's really it for this week. I really wanted to spend more time talking about the concept of the three balancing acts and how that is a way to think about your positions. I hope you found that valuable. And just to give you an update for those of you who have been following some of these recommendations or are a client of ours who own these stocks, just so you can see what's been happening with the earnings. This is Llanes with Wealthnet Investments Market Call of the Week. Glad you could be with me, and want to wish you a happy trading and investing. Okay, talk to you later.